Hey guys, Steve Palise here. One of the common theme I'm hearing from most property investors is with commercial and rising interest rates, the cash flow isn't going to be as strong as it was a few years ago, and therefore they're not going and buying it because it's not worth the risk. However, I thought when you're looking at the risk and you're going to change that mindset and buy residential instead, it's worth looking at the difference of the residential cash flow at the same high interest rates versus the commercial at the same high interest rates, because I actually believe that commercial can be a lower risk if you get a good quality asset. So let's have a look and compare the difference. All right, so I've chosen some fairly arbitrary numbers here. So I've got $1 million residential property on a $750 a week rent. That equates to a 3.9% gross yield. I've taken into account some typical outgoings like building insurance, landlord insurance, rates and water, $1,500 a year for repairs and things like that. And then we're having a look at the cash flow depending on the different interest rate rises. So you can see here an 80% loan at a 4% interest rate. You'll get about $39,000 a year rent, and you take off the outgoings, the interest, the rental management, the repairs, the insurances and rates and things like that. And you're fairly neutrally geared. You're $730 a year negative. If, for instance, you're pulling out equity from another property to purchase that one, you have 100% debt level, then you can see 100% loan at 4%, you're about $8,700 a year negative. So that you can somewhat stomach, and this is a whole argument with negative gearing and getting the growth from the negatively geared asset. However, if interest rates start climbing up, so let's just say they go up to 8%, an 80% loan at 8%, you'll actually see the cash flow is negative $32,000 a year. If that property is 100% leveraged against another one, you're talking $48,000 a year negative. If interest rates, and hopefully they don't go this high, go to 10%, an 80% loan, you're actually $48,000 a year negative and $68,000 a year negative for a 100% loan. So this is why banks will stop lending to you with serviceability. So they're going for higher interest rates and working out what you can afford with your current outgoings. So that for me is quite scary if you've got a large portfolio, and you should always stress test your portfolio against high interest rates and just kind of assess your risk profile and what you can afford when you are accumulating those assets. But now let's have a look at commercial property. So same deal, I've chosen $1 million property on a 6.5% net yield. So it's currently March 2023, and that's a yield you can achieve in areas like Brisbane and Perth. You'll get a nice little warehouse there for that price. With commercial, no outgoings, tenants pay the council rates, water rates, the maintenance, the insurances and things like that. So basically what hits your pocket, the only outgoing you're going to have is a little bit of rental management. But looking at the same numbers, so we'll go a 70% loan on the commercial, and we can look at 80%. We'll go 70% because you do typically need a slightly bigger deposit with commercial. A 70% loan at 4% on a 6.5% net yield, you're $34,000 a year positive, which is still quite attractive if you're looking for a passive income at 4%. If you go an 80% loan, so you can compare apples and apples, you're $30,000 a year positive. So for me, that's quite attractive. And then similarly, as we increase the interest rate to say 6% up to 8%, an 80% loan at 8%, you're actually only $1,600 a year negative. So basically neutrally geared, and this just means you can hold the asset long term. So as long as you keep your tenant and you're bought in a real tightly held area and they keep paying rent, you can hold that property and weather the high interest rate storms. If we say go to 100%, if we go to say 10% on an 80% loan, you're only $17,000 a year negative. So that's still stomachable as well. And just comparing that with residential. So remember the numbers on an 80% loan at 8%, we were negative $32,000 a year, and at 10%, $48,000 a year. So there's actually quite a big difference between that. We're talking $30,000, $40,000 a year difference in holding costs. And this is where I think you need to compare apples and apples and say, commercial is high risk in terms of losing the tenant and vacancy periods, but in terms of cash flow, it means you can actually weather the storms. The real power from commercial, if you can get a capital growth commercial as well, which on average, commercials do grow the same as residential properties, just certain ones don't grow as much, like office space and retail. But industrial, for instance, will have the same capital growth, and we get, say, 6% capital growth out of the property. This is where it becomes very attractive. Like you can see, even when you've got an interest rate of 8%, we actually end up with a total net return of $66,000 a year, because we're effectively getting the 60 grand capital growth plus the 6 grand cash flow. You can still make some money in this asset. So anyway, I just thought I'd run you through that, because there's a lot of people getting confused with what the risk profiles are versus what the cash flow are.